Hello class, this is Dr. Fenton. Now Chapter 2 covers the accounting cycle, and this will show us how to enter accounting information into the accounting records during the period. Now I will tell you that this chapter covers a lot of material. There is a tremendous amount of material in this chapter, and you'll need to spend a lot of time here. Please read the chapter, reread it carefully, follow the examples through, and some of those same examples in the chapter I'll be covering here. So just be ready for a lot of material in this chapter. Here are the 6 steps you need to be aware of when we're trying to enter what are called external transactions into the accounting records. We need to eventually make accounting entries into the general journal and get those into the general ledger accounts. And all that will be explained as we go through the slides here. The first step is you need to find the source documents that we use to identify the accounts affected by a transaction. Source documents can be a check you've written, an invoice you received, a statement you received, some type of document that relates to dealing with an outside party, someone outside the company. Then we will see what the transaction was. We will evaluate it as to the accounting equation in step 2. And there, if you remember the accounting equation, we have assets on one side and liabilities and stockholders' equity on the other side. Step 3 gets into debits and credits, and when we analyze the transaction, we also decide which account should be debited and which account should be credited. Step 4, enter those debits and credits in the general journal, just called a journal here. Then later in step 5, post those journal entries into a general ledger that is an accumulation of all the accounts that we use. And then finally, we prepare a trial balance. So as I said, there's a lot of material in this chapter, so let's get started. Now, an account is a summary of all transactions related to a particular item over a period of time. So the first example shown is cash. We will have a separate account for cash. We will have to record in that account all the increases to cash and all of the decreases to cash. And at the end of the accounting period, we need to find out in any account that we're dealing with, what is the balance as of the end of the accounting period. So how much in cash do we have? How much in supplies do we have? How much equipment do we own? So that's what an account is going to show us. It's going to show us all the transactions for a specific account during a time period so that we can find the ending balance in that account at the end of the accounting period. Liability accounts the same way. We're going to owe people money either through suppliers and accounts payable. Employees, we owe the employees some through salaries payable. We owe the utility company some money, and we owe some taxes. So we keep up with specific accounts in all these areas, as well as in the stockholders' equity section. And the 2 accounts here we've dealt with so far are common stock and retained earnings. A chart of accounts, just for definitional purposes, is a list of all the account names used to record transactions. Here's the accounting equation I just talked about. We saw this in Chapter 1. And again, one more time, remember, at every point in time, with every transaction, after every transaction, and at the end of the accounting period, all of your assets must equal the total of your liabilities plus stockholders' equity. If we have an increase in total assets, then we must also have an increase in either total liabilities or stockholders' equity. So, like I said, both sides must balance. And if total assets decrease on one side, the left side, something on the right side must also decrease. Now, for each transaction, we have 3 questions we need to ask and find the answer to. What is one account affected by the transaction? Like, is cash affected? And does cash increase or decrease? Then there must always be a second account affected. And does that account increase or decrease? And finally, with each transaction, do the assets equal the liabilities plus stockholders' equity? And that accounting equation, I have already mentioned a couple of times, it must hold true at all points in time. your assets must always equal your liabilities plus stockholders' equity. Here are some transactions, 10 of them, that we're going to go through and show the effects on the accounting equation. So you can stop this slide, look at it if you want to, find it in your PowerPoint slides you can download, and it's also in your textbook if you're using the 4th edition. The first transaction is the very first transaction a corporation will have. It has to get cash or other assets into the business. The owners will put that into the business, and then the corporation will then give the owners stock certificates, in other words, shares of stock. So if we have the corporation selling common stock to the new owners for $25,000 cash, then what is one account affected by the transaction, and does that account increase or decrease? Of course, cash is affected. It's coming in the door and is increasing. All these transactions we're going to deal with throughout the course will always be through the eyes of the business. So even though the stockholders are giving cash to the business and their cash is decreasing, we are not worried about that transaction. We are worried about the transaction to the viewpoint of the corporation. So from the corporation's viewpoint, cash is coming in the door, so we're going to increase cash by $25,000. Now, there must be a second part of the transaction. And what account is affected? Well, we are issuing common stock. We, the corporation, we're issuing common stock, and that account will increase by $25,000 since we are sending out shares of stock. Here in accounting equation format is just what's happened. Cash went up $25,000, and on the other side, stockholders' equity, more specifically the common stock account, went up $25,000. So this one transaction, the left side of the equation equals the right side. Plus $25,000 equals plus $25,000. With the second transaction, we need more cash, and so the corporation goes out and borrows from the bank $10,000. The cash account goes up another $10,000, and then you answer the question, why did this cash come in the door? Did it come in from selling more stock? No. This cash came in the door from borrowing money, and therefore a liability account we'll call notes payable increases. We're calling this notes payable because we have to go to the bank and they will do a credit report on us. They'll ask for our assets and liabilities personally or the corporations, and then they will make us sign a note. And the note will have a due date that we're going to repay and an interest rate. After this transaction is entered, then we now have total assets, all in cash, $35,000. And we have $35,000 on the right side of the equation made up of two different parts. Liabilities, $10,000, and stockholders' equity, $25,000. So what I like to say about this is the left side of the accounting equation, and also if you're looking at the balance sheet, the left side of the balance sheet shows the total assets the company has. The right side of the equation, and also the right side of a balance sheet, if we were looking at it, shows how those assets were financed. So we have $35,000 in cash on the left side. On the right side, it shows where the cash came from. We had the owners pay $25,000 into the business, and the business borrowed another $10,000. In transaction 3, we used $24,000 cash to buy equipment. We're going to lower cash with this transaction and also increase another asset, equipment. Both of these are assets. You can see nothing on the right side of the equation is entered because liabilities are not affected, nor are any stockholders' equity accounts. But the equation still balances because we have a negative 24 on the left side as well as a positive 24, so that nets out to 0. So everything stays in balance. We still have $35,000 on the left side as well as the right side. And on the left side, the assets, we have two different kinds of assets though. $11,000 in cash, $24,000 in equipment. That totals $35,000. Transaction 4. We pay 1 year of rent in advance, $6,000. So for some reason, our landlord decided, if you want to rent this building, you have to pay us, the landlord, a whole year in advance. So we write the check for $6,000. So we know cash is going down $6,000. And since we are prepaying the rent so far in advance, we are not going to enter this as an expense, not yet, rent expense. We are entering this as an asset because prepaid rent represents a future benefit that we're going to be able to use. We've prepaid the rent for a year, so that is considered an asset. We still have $35,000 on both sides. So notice, with each transaction, the accounting equation stays balanced. And after every transaction, when we pull off the new totals, the equation stays in balance. Transaction 5. Let's purchase supplies, except not use cash. We're going to buy supplies today and pay the supplier later. So the supplies is an asset account, goes up $2,300. And now we owe the supplier the money. We have not paid the cash yet. That's accounts payable. So we're going to increase accounts payable, which is a liability account, also $2,300. So you can see assets went up now to a total of $37,300, and that's also the amount we have on the right side. Our liabilities now total what? $12,300. Stockholders' equity is still $25,000, and they total to $37,300 also. So let's expand the accounting equation to see what fits in under the stockholders' equity section. So far, we've dealt with two accounts. Common stock, that's what the owners have paid us for the common stock, and then retained earnings. We haven't entered anything in the retained earnings account yet, but this will be an accumulation of all profits and losses over the previous years. And of course, we saw in Chapter 1 that to get to our net income or net loss for the period, we have to know the revenues we've had and the expenses. Now, you can see that the retained earnings account is now expanded further, and we see revenues and expenses, and that will be our net income or net loss each period. And then also, if we pay out dividends, then we're going to take that away from the retained earnings account. So keep this in mind. This is going to get more detailed, especially in the stockholders' equity section. Revenues, you can see, will increase retained earnings. Expenses will decrease retained earnings. And also dividends will decrease retained earnings. So let's look at these in more detail. The next transaction is, let's provide some golf training lessons to customers, and they pay us cash for $4,300. Our cash account is going to increase $4,300. You see that on the left side. And on the right side, we're going to place under the retained earnings account $4,300 because we have just earned some revenue. We have service revenue. So service revenue is a component of stockholders' equity. Cash comes in the door, that's recorded on the left, and the revenue account is recorded on the right side of the equation. The equation still stays balanced, and now it's up to $41,600 on both sides. Transaction 7. Let's provide golf lessons to customers, except they are going to pay us later. They're not paying us today. We've done the work today, we've had earnings today, but they are going to pay us the cash later. To enter this, we don't increase the cash account. They have not paid us yet, but they owe us the money, so we are going to increase another asset account called accounts receivable. And then under retained earnings, we're going to increase this $2,000. So when we do the work, whether we've earned the cash, whether we've collected the cash immediately or we'll collect the cash later, if we've earned the revenue, it is recorded as revenue under retained earnings. The totals still match on each side. Transaction 8, let's now receive cash in advance. So customers are going to pay us $600 in advance, but we have not earned it yet. This is called, you can see the account under liabilities, deferred revenue. We're going to defer the recognition of the revenue until we provide the lessons in this case. But they pay us in advance. So we do add, since we have it in hand, we do add $600 to the cash account. We have not earned the money yet, so it does not go under retained earnings. We owe these customers some lessons, so it's a liability. This deferred revenue account, like the next slide shows, Don't let this name fool you. Deferred revenue does not mean revenue we've earned at this point in time. It just means we're going to defer when we recognize the revenue, and we will record it as revenue when we actually earn it at a later date. So this is a liability. Transaction 9, let's pay our employees. We pay them $2,800. Cash goes down, and salaries expense, just like any revenue or expense, goes under retained earnings. So negative on both sides. The equation still balances. And finally, the corporation decided to pay some dividends to the shareholders, to the owners. So let's pay $200, use cash, cash goes down, and also dividends go under retained earnings, and that's a negative $200. Add everything up, and still the two sides balance, and we were at $41,200 at this point. These are the 10 transactions, used as examples. With each transaction, the accounting equation stays balanced, and after each transaction, it stays balanced. Here's a summary. So looking down through here, you see a lot of transactions for cash. Cash coming in the door, going out the door, and then the next set of numerous transactions will be under retained earnings. We had revenue that we collected cash immediately. We had revenue where we did the work, and we will collect the cash later. We paid the salaries, and then also we paid some dividends. In the second part of Chapter 2, we start talking about debits and credits. We have to find a way to enter the information into the actual accounting records. Companies don't use the accounting equation format that we just saw, that was used for demonstration purposes, so you can sort of visually see how the accounts are affected, how they increase, how they decrease, and how the accounting equation stays balanced at all times. Debits and credits are an accounting tool, again, to make the former journal entries. And you'll just have to memorize these at first. For all of your asset accounts, debits will increase those accounts and credits will decrease those accounts. And the only thing debit means is the left side and credit means the right side. And whether that is an increase or decrease depends on the type of account you're working with. So again, assets have the rule that if you're going to increase that account, you're going to debit that account. And if you're going to decrease an asset account, you will credit that account. Liabilities, it's just opposite. This keeps everything in balance. So liabilities will decrease with the debit and increase with the credit. Stockholders' equity, in general, follow the same rule as liabilities. They will decrease with the debit and increase with the credit. So what happens here is, from this point on, yes, the accounting equation still stays balanced. And also, at all times, your debits equal your credits with every transaction and with every total after every transaction, and also at the end of the accounting period. Here's an expanded format with all the rules. You will see that under stockholders' equity, follow that down under retained earnings, right here. Here's the rule. They increase with credits, decrease with debits. Revenue, same rule. But you will see expenses have a different pattern. They increase with debits and decrease with credits. And yes, this is the correct rule, even though they fall under stockholders' equity. This is the pattern for expenses as well as for dividends. So I know this is a little bit confusing. That's why this chapter will take a lot of time to review all the rules. Here is maybe an easy way to understand the rules. They use the word dealer. And so if you take the first three letters, dividends, expenses, assets, they all increase with debits. And the LOR, liabilities, owner's equity, and revenue, they increase with credits. So if you can memorize this and this helps, that's great. This is a journal transaction. Sometimes I will call this a general journal. It means the same thing as the journal. This is how you finally, formally, get the information into the accounting records. You will debit at least one account and you will credit at least another account. And as always, debits will equal credits. Let's go back to the very first transaction. Again, December 1st, the corporation sells common stock to get cash in the business. We've already seen this transaction earlier, and we know that the cash account increases and the common stock account increases. The rule for assets will be to debit an asset account when it increases. So here we will debit cash. The increase for stockholders' equity accounts is to increase those with credits. So we credit the common stock account. So we are increasing both of these accounts. That's what we did in the accounting equation. That still holds true. But also we have one debit and one credit, and the dollar amounts equal each other. So that's why I said that, yes, assets will always still equal liabilities and stockholders' equity. And from this point on, total debits will always equal total credits. Here are just a review of the transactions we've seen before. There's the first one again. We debit cash, credit common stock. On the second entry, we have cash coming in when we borrow money. And this plus A means you're going to increase an asset account and you're going to increase a liability account. So the entry is to debit cash, credit notes payable. You are increasing both of those accounts. December 3rd entry, we increase equipment because we are buying more equipment, so assets increase, but we're using another asset, cash, to pay for it. So we're going to decrease the cash account. So we're going to debit equipment and credit cash. Prepaid rent, again, we're going to debit another asset account, prepaid rent, and credit another cash account, another asset account called cash. And the debits equal credits. And the accounting equation, like we saw before, still holds true. You can look down through the other entries. With every one, the accounting equation still holds true, and now debits equal credits. We buy supplies on account. Debit supplies, an asset. Credit, accounts payable, a liability. We're increasing both of those. Let's provide services to customers and receive cash. Debit, increase cash. Credit, increase service revenue. Let's provide services to customers, and we're going to collect the cash later, so they still owe it to us. We debit another asset account, account receivable, and credit service revenue. Then on the 8th transaction, let's collect cash in advance. We're going to provide the service later. It's a liability, as we talked about before. Let's increase cash and increase deferred revenue. And the last two entries, let's pay the salaries. So salaries expense, this is an expense account, and the rule is to increase expenses with debits, and we're paying cash, so we decrease the cash account with the credit. Pay dividends, a similar rule as salaries, salaries expense. We increase dividends with a debit. At the same time, we are decreasing total stockholders' equity like we did here. But we are increasing these individual accounts, and of course we are decreasing cash. So those are the 10 transactions. And the next point in the accounting cycle is we have to get the journal entry dollar amounts into the actual account themselves. That's called posting. And this is sort of like in a T account form here. You can see we have debit, credit. This is the T you can see. We take this entry and post it to the cash account just like this. This is the account just for cash, nothing else. So we're going to increase the cash with the debit in this T account format called a general ledger account. This is a journal, this is a ledger. And you'll have a separate ledger account for every account that we've dealt with. Here's the common stock account. So we have $25,000 credit to this account, and now it shows the ending balance of $25,000 after this entry. So up here in the cash even, cash is increasing 25. After this transaction, the balance is $25,000. So you would do this for every item we have in the journal. Every transaction, every account goes into this general ledger just like this. After you get through posting, here's what we've done. Again, you can sort of see the T, cash account T. we've recorded all the increases to cash as debits, all the increases as credits. Now we can summarize these and add up all the debits, subtract all the credits to find out how much cash we have. So this is the ending balance in the cash account. Liabilities, accounts payable, 1 entry, same as common stock, supplies, 1 entry. Most of these other accounts have 1 entry. Revenue had 2, 6,300. So you take the numbers after entering the general transactions, and you post those into these individual ledger accounts, these individual T accounts that you can see here. After this is done, we prepare what's called a trial balance, and this is just a list of the accounts we've used so far. Show all the balances, see all the debit balances, all the credit balances, and this is a check to make sure after all the transactions we've gone through and after all the posting from the journal to the ledger accounts, do the debits equal the credits? If they don't here, something's wrong someplace. This must equal. The total debits must equal the total credits. If that's so, then also the accounting equation holds true, where your assets still equal your liabilities and stockholders' equity. Now, this trial balance is not a balance sheet. We're going to see that in the next chapter. This trial balance is just to check at this point in time, do total debits equal total credits? This is the end of chapter 2. So as I said, this is a lot of material, a lot of detailed material in this chapter. Please spend a lot of time reading the book, rereading it, reviewing this video, and doing the other work that's assigned. So good luck with your studies, and we'll see you in chapter 3.